Welcome to Your Inheritance, your rights, your obligations, your responsibilities, with your host, Peter Bochnewich. In each episode, you'll learn insights from experts. If you're being sued over an estate or if you feel you're not getting your share, Peter's firm can help you. You can find this show at www.betrustlaw.com and on YouTube, Facebook, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Your Inheritance, Peter Bochnewich.
Hello. Today we're going to discuss the future of the market, the stock market in the coming year, 2023, and longer term. These are important considerations for anyone who invests money or manages money, whether you're a professional trustee or a family trustee. These are important concerns. Our guest for our discussion today is David Allen. He is a chief economist and research analyst with Private Asset Management, which is a fee-based wealth and asset management firm based in San Diego, California. David graduated magna cum laude in 2012 from the University of Maryland. He has degrees in mathematics and economics. David is a CFA charterholder and a member of the CFA Society of San Diego. David is also a certified financial planner, a CFP, that's a registered term, and that's important, and we'll talk about the significance of those roles and those credentials, which is important for anyone seeking to have someone manage their money. Which, big caveat, I have to say this is only a discussion, and nothing in this podcast is intended to provide or will provide financial advice or legal advice. Viewers should contact their own financial advisors for that purpose. Maybe give David or the folks at PAM a call, PAM, fine group of people, and I personally got to know the founder of the company, Mr. Stephen Cohen, very well. It's always my advice, never try this at home. If you're a family trustee, a lot of problems happen in the management of family trusts when someone takes over a trust and they're really not astute at handling money very well. And it's good to have professionals. You could always protect yourself from liability by hiring the right professionals. So today we just wanted to have some discussion about what's going on in the economy and what's going on currently and what might be happening short term and a little bit longer term. And David, 2022 saw some difficult times with inflation, lingering supply chain problem, rising interest rates, all of that. What did the final months of 2022 show us, and what might that mean for 2023?
Well, first, Peter, I want to say thank you for having me and getting a chance to speak with you and your audience. You're right. I mean, in terms of what we've seen over the last couple of years and on the inflationary front for the economy, it's been pretty dramatic. Beginning in early 2021, we began to see inflation pick up well above the 2% target that monetary policymakers have for inflation. A lot of that early on was driven by higher energy prices as well as higher prices for agricultural commodities. But it wasn't just isolated to those categories. Core CPI, which looks at overall CPI excluding food and energy, also it was increasing sharply up to 6.6% by September of last year. So a lot of that had to do with broken supply chains and high consumer demand. We had consumers who were at home, who were spending quite a bit on goods, and that was feeding right into broken supply chains and really not allowing them to heal themselves because there was so much demand flowing through those channels. So that was a lot of what we saw in the first, maybe 3 quarters of the last couple of years. But in the last half of 2022, we began to see inflation slow down. Really a welcome sign for anyone who's paying attention to the economy or to financial markets. We've seen overall CPI trend down to 6.5% in the December reading from 9.1% in June of last year. And core CPI, that category that excludes food and energy prices, is down to 5.7%. So both of those are still above target, but we are trending in the right direction. And a lot of that's been fueled by some of the things, a reversal in some of the factors that we saw driving inflation early on. Cheaper energy prices, consumers whose preferences are shifting away from goods and more towards services. As the economy reopens, people are feeling more comfortable, going out and returning to restaurants, going out and consuming services. So that's been driving a lot of the shift. Supply chains are much better now. But in addition to that, we've seen interest rates really climb higher. That's been a big factor in lowering inflation too. That's coming from the Federal Reserve using their traditional monetary policy to slow down the economy and try to bring inflation back to trend.
So raising interest rates is a tool, I guess, for the Fed to curb inflation. And then the question that arises in the minds of most lay people or anybody is, what do all of these factors have to do with the probability, which you hear a lot about, that there might be a recession coming? Is there the possibility of a recession now? Are things trending away from the possibility of a recession? I think I accessed some information on your website that at one point, even early in the month, there was a suggestion, according to Bloomberg, that the median estimated probability of a recession over the next 12 months was 65%, which sounds kind of high. It sounds like it's more likely than not that it's going to happen. That's better than 50-50. What does the data tell you about that today at the beginning of February 2023? Is that something that folks should be concerned about?
I think the risk of a recession is certainly higher than it was a year ago. You're right that the consensus probability that economists have for a recession over the next 12 months is 65% right now. That's up from about 15% a year ago. So the risk is much higher, like you said, more than 50-50. But it's not just, economists' forecasts. There are other indicators that perhaps things on, economic horizons are not quite as bright. We've seen a yield curve inversion in financial markets. Consumer confidence is very low. CEO confidence also low, and small businesses are reporting fairly low expectations for the next year or so. So all of those together, those are all pretty good recessionary indicators. One of them could be inaccurate, giving us a head fake, but that all three and are showing, pointing in the same direction, and all three would be wrong. It's less likely. So recessionary risks are higher. There's no certainty there, but it certainly is something we should be paying more attention to.
Okay, so, and I know we're not here to give specific advice, but what might people do with this looming possibility or probability? And I would suggest that panic is not one thing that they should do. It sounds like with the predictability that you have of these things, you look at this data and you can see we're not in a recession now, but we could see one coming, and they happen from time to time. And what should people be doing? And how would you advise people to respond to this looming probability?
Well, like you said, panicking is not the right thing to do. Panicking as an investor rarely results in welcome financial outcomes. You want to try to stay as unemotional about things as you can. It's easier said than done. Obviously, investing is a very psychological process. So, I think, like you said, putting the current environment and potential recession in context is helpful. Recessions are fairly normal. Going back to 1854, that's when we have sort of the real solid data on economic expansions and contractions. We've seen 34 recessions here, and they've averaged about 17 months on average. And so you can check my math, but roughly 30% of the time over the last 170 years, roughly, we've been in recession. So that's, it's not an uncommon occurrence. It's something we've seen before, and something we will undoubtedly see again.
That's very interesting. When you say that, when you go back to 1854, 34 recessions, averaging 17 months on average, which is, I would actually think that the recessions in recent times have been shorter rather than longer. I know that we've had periods where they've been in the past where they've been longer, but it suggests to me that recession, or some state of it, is rather normal, kind of a regular occurrence. Is that kind of just a natural market adjustment type of thing? How do you explain that?
Absolutely, it is natural. I mean, we learn in our introductory economics courses that economic growth isn't monotonic. It doesn't just continue up in a straight line. We do have boom and bust cycles, and that's part of normal economic functioning that we see. And going back to something you also said, it does feel like recessions are not quite as long as they were perhaps pre-World War II. A lot of that has to do with modern monetary policy, using interest rates to try to reduce the peaks and valleys in economic output. And that is something we've seen since World War II. On average, recessions have been shorter, which I attribute largely to more theory-based monetary policy in developed markets.
That brings up a couple of other questions I have, and I'm probably going to go out on a limb here a little bit as we explore this topic. And we've just touched on it briefly here, but when you talk about the market, the stock market, people who they always talk about stock market corrections. There's something in the market that corrects a particular trend, whether it might be, you have a correction in the real estate market. The real estate market gets hot, prices are really high, and then all of a sudden things have to come down to reality. That happens in the market. Is a recession kind of a corrective thing in an economy such as the United States economy or any economy?
It definitely can be. There are parallels between economic recessions and a market correction. Certainly, in some cases, we have an economy that has there have been some bubbles that are created. The housing market bubble that around the Great Financial Crisis is certainly an example of that. And a recession can actually help the economy consolidate, form a stronger base, and from that base can then grow into the next expansion. Not all of them are that way. Obviously, the most recent recession in the early days of the pandemic was not one of those. That was not a case where we had excess that was building up. That was exogenous to the economy. It was obviously having more to do with the pandemic than anything that was intrinsic in the economy.
So is there a relationship, in your view, between the duration and the impact of recessions?
There's common sense tells us that there should be. The longer that an economic contraction is ongoing, the worse it is for the economy. But actually, if you look at the data, that isn't necessarily true. The relationship long term between the length of an economic contraction and the depth of that economic contraction is barely positive. And so, sometimes we have contractions that drag on for a long time but aren't that severe. And like what we saw in 2020, we can have very, very short contractions that are just a couple of months long in the case of the pandemic recession, but that were sharp, output falling quite considerably. So there's not a real strong positive correlation between the two.
And some investments do well in recession and some do not. I mean, it's a mixed bag, I suppose. Can you comment on that a little bit?
Yeah, it's again, there's this idea that if the economy is contraction, that should be bad for particularly equity markets. I think that's where a lot of people head when they're thinking about those things. But again, that's not always the case. We've had 10 recessions since the S&P 500 was created, and in 4 of those, during the contraction, we actually saw growth in the S&P 500. It's not always the case that that the market is reflecting exactly what the economy is doing. It's one of the interesting parts about looking at economics and markets is that what the economy tells us isn't the economy and the stock market are not the same thing, though they may seem to somebody who hasn't been active in it and paying a lot of attention to it.
Right. It always occurs to me that the markets companies are going to respond to economic conditions, and they are generally going to make the choices that are going to manage their businesses and respond to the stimulus in the market or the lack of stimulus in the market or demand or whatever, and they fix themselves if they're going to survive. So if you're investing in a particular sector, when things are booming and the market's going up, you get the benefit of growth. But when things maybe contract a little, but there's opportunities for investors to make purchases at better levels. And overall, in the long term, those ups and downs in the markets, I think, are part of a natural process of over the long term, building the wealth of a trust or whatever investment portfolio you may have. Could you say that a stock market downturn, although the the stock market is not the economy. You made mention of that. Is a stock market downturn ever to be considered a bellwether of a recession coming forward? What sense of indication do you get from that?
So we can. I mean, one of the things that's important to keep in mind is that the market is forward looking. It's not looking at conditions today and pricing based on that. It's looking at where expectations are for the future and then trying to reflect that in the prices that we're seeing in the market now. So just like what we've seen, recently here in the US, the weakness that we've seen in equity markets is to a large degree a reflection of expectations for slower economic growth and perhaps an economic contraction. And so that is not out of the question to say that, or it certainly is reasonable to say that we can see downturns that are a harbinger of an economic recession. However, we see downturns in financial markets that don't result in economic recessions also. Paul Samuelson once famously quipped that the stock market has predicted 9 of the last 5 recessions.
Right.
So it's something that we get lots of false signals if you're just paying attention to particularly equity markets in terms of what that's suggesting is going to happen in the economy.
Can the market ever signal the next expansion?
Well, yeah, I mean, it's the same sort of rules apply. It's still forward looking. So even though the economy may not have begun to expand, investors are looking at the conditions and where things are trending, and they're making pricing decisions based on that. And so it's very common for us to see, during an economic recession, for equity markets to pick up towards the latter stages of that recession, and that it ends up being the case that we can, basically, see a pickup in equity markets before the recession has even ended.
But I don't think it's possible, or maybe you can tell me that it is or not, that it's possible to use the cyclical nature of recovery and expansion to in any way really predict or time the market. I mean, you have to be pretty sophisticated to do that. What can you tell us about that? Timing the market. People always try to time the market.
Right. I think there's a lot of people who spend a lot of energy, engaging in those sorts of activities. It's very difficult if you're trying to time the market based on where you think we are in a recession. Recessions are dated by a government organization called the NBER, the National Bureau of Economic Research. It's a team of relatively few economists who date these things, and they usually announce the beginning of a recession with a very significant lag. I mean, and the end of a recession with a significant lag. And so it's very difficult to know in real time where the economy is. And so, if you're not going to find out that the economy has exited a recession until 15 months after that date has passed, it's difficult to form any sort of investment timing mechanism based on that because of the long lags that we see.
So what can people do?
Yeah, that's always the question. I mean, one of the advice that we give, I think it's with our clients, we're always cognizant of the difficulties. People are aware of the risks and they're looking to do something, but often the best thing to do, the advice that we give them, is to stay invested, to maintain your investments, don't overreact, try to not become emotional about things. If you look historically, since 1928, going back the 30 best trading days on the S&P 500, if you weren't a participant on those days, but were participating in the market every other day, you would see about half of the cumulative return in S&P 500. And so being able to participate in those up days is an important part of being an investor, and why I think the recommendation is almost always to stay invested to the extent that you can.
You stay invested for the long term. It might change a little bit depending on where you are at in your life. Retirement, managing funds for an elder if they're nearer to the end of life as opposed to in the middle or whatnot. Then their more conservative investments might be well advised. That those are topics that we could discuss perhaps in another podcast. But looking forward in the economy, do you see any bright spots in the horizon 2023? And I just wanted to go back to something that you said before we get into that. 2008, we had a big meltdown. And I remember what was the overall volume of the market at that point. I think it was it went from 14,000, I guess it was, to 7. And now people are saying we're struggling. The market is struggling, but it's the overall volume of trading and everything is I think doing. It seems high. It seems like it wants to go higher. It seems it's pressing. It's looking at the data even as of today, and it seems like, maybe in a year from now, once we get through and we have the next recovery, the overall, and that volume, that's the overall trading volume. When they say the overall is 40,000 or 33,000, what does that mean, and what does that indicate, and where do you see it maybe being a year from now? Are there bright spots on the horizon coming down the pipe?
I think what you're talking about is, there are some competing narratives about where financial markets are, where the economy is headed, and a lot of that trading that's happening is those different narratives playing out, and people making investment decisions based on their narrative. Somebody else maybe has a different narrative, and that's driving a lot of the volatility that we're seeing, particularly in equity markets. It's not abundantly clear. I mean, we talked about the recessionary risks, but as you asked, there are some bright spots. The labor market is incredibly tight right now. Out this morning, we had the jobs data for January. We saw 517,000 non-farm payrolls added, and the unemployment rate fell to 3.4%. So, the labor market is not suggesting that we're heading into a recession. It's suggesting that this expansion is still well underway and quite strong still. So, there are a lot of cross currents within the economy. Though the recession risks are higher, it's far from certainty that we're going to see one.
3.4% is that what would be considered close to full employment? It can. I mean, I remember there was I remember economics from undergraduate. I'm not an economist. I'm a lawyer, not an economist. But the full employment is not zero unemployment. It's people changing jobs and whatnot. So I think it was like 2.9% or 3% was considered to be generally to be a level of employment was full employment. And now you're telling me that the data today is that basically at that.
Right. So yeah, the level of full employment is variable. It moves over time, and it's largely dependent on how efficiently we can match people that are looking for work with a job. And so things like technology can affect that. Industry death and growth in other industries, that can also affect that. And so right now, I think we're actually in a period where the level of full employment is a bit higher than what we've seen in the past. It's about 4%, maybe a little higher than that. That's where the Federal Reserve estimates it at 4.1% right now. And so we're at 3.4%. We're below that. We're seeing an incredibly tight labor market. Job openings are at very, very high levels. So, it's one of the most positive. It's one of the biggest strengths in the economy right now is the level of job creation and the labor market overall.
Do you see the future of technology as developing to fill the needs of that tight labor market to make individual workers more productive or companies more productive? Because they can't find workers, so they start using technology, and that creates better jobs for people who know how to use the technology. And it also increases the productivity of the companies because they need the workers, but they can't get the workers, so they have to come up with solutions to make workers more productive, and that might be through the development and deployment of better technologies. Can you comment on that?
Yeah, I certainly agree with you. I mean, and increasing productivity of the labor supply that we have available to us is one of the things that's going to generate wage growth. And so we've seen quite a bit of wage growth recently, and I think enhanced use of different tools. I mean, whether or not there's AI and things like ChatGPT are certainly dominating the headlines early this year. There's a lot of concern about that. Is that going to steal jobs? Is that going to result in job destruction? And it may in certain industries, but it's also going to make workers more productive, able to produce more, and eventually drive wage growth. So absolutely, I think technology is something we saw that last year. we saw businesses making large investments in their equipment to bolster the productivity of the labor force that they could gain access to. It's hard to find people to fill positions, and so you have to get more out of each employee you do have, and that's driving a lot of investment that we're seeing across companies, large and small.
I would think that the development and the expansion of this concept, we know it's coming, artificial intelligence and everything. I mean, it's going to affect the workplace. It's going to affect everything we do. It's already affecting banking, it affects communications, everything is going to be affected by it. But it would seem to me that once the glitches that certain prominent people are fearful of what are, doomsday scenarios of what artificial intelligence could do to humanity or whatever. But if deployed in the right way, it could just be a mind-blowing expansion of opportunity in ways that we've never even seen, and we could have growth industries that aren't even invented yet, potentially doing things, robotics and all of these different things that are just going to revolutionize a new industrial revolution, really. I mean, it could just change things, and hopefully that might be able to solve some of the problems that we have with climate change and things of that nature. And there's all kinds of things that could develop from that. You touched upon something earlier about federal monetary policy, and I just want to get back to that a little bit. How important, in your opinion, is federal monetary policy on the durations or even the prevention, at least in part, of the length of any recession?
Yeah, so like we were discussing earlier, the post World War II, which is really when modern monetary policy came into use, we have seen recessions that are not quite as long, and I think that it's not a coincidence. It's because monetary policy makers are able to influence the economy using their interest rate policy. If growth is too slow, they can cut interest rates, ease financial conditions, allow some stronger economic activity to blossom. And on the other side, if things are getting a little overheated, if we're seeing some bubbles, they can begin to raise interest rates and pull back on some of that economic activity. And really, the idea is to flatten, not to get rid of the boom and bust cycle, but to flatten the amplitude of the boom and bust, make them not quite as severe, keep us more or less on the track towards growing the economy, keeping it within the lines, so to speak.
So basically, you don't want to over meddle in the economy, and a lot of people adopt the philosophy that we should just be hands off. The government should never be involved in the economy too much. But an over meddling may not be good, but under meddling or some lack of purposeful involvement at key times is not good either. And it sounds like what you're saying is that the government's involvement in tweaking things in particular ways is good for business, and the government can, I don't know that they work together, but they can benefit from that policy, certainly.
Absolutely. That's my point of view. I think there are people who would wish that the government was less involved. I think there are certain ways, certain specifics about how the Federal Reserve has gotten involved in asset purchases that are distorting markets or have distorted markets that people have a lot of criticism for. But in terms of a central bank, standing sort of apart from the government, is independent of the government to some extent, and is also standing apart from markets, and is trying to keep things moving in a positive direction. I think that's invaluable to modern developed economies.
That's what we have here, and other places do not have. Other countries do not have. It's that that's an important concept. The central bank is independent, right? It's part of the government, but it works independently to effectuate these policies.
Right. So you're right. In some countries, we see a lot of integration in between the political leaders and those central bankers, and that results in outcomes that are suboptimal in almost every case. The Federal Reserve isn't entirely set apart from the government. They are, the Federal Reserve chairman and the governors are appointed by politicians, and they are subject to government oversight. But those decisions that they make on every 6 weeks when they have a meeting, there is no undue political influence typically in those decisions. They're making them based on the data they have available to them, And that seems to be the arrangement that works best, not just here, but in major central banks in Europe also.
I believe that's a comforting part of our system that we have here. I mean, I think the appointments are obviously going to be skewed towards the political parties. If you're Democrat or Republican, you're going to have they're going to go in a general direction. But it does seem to me that the people appointed to those positions have the integrity. Generally, over time, we see that their goal is to help manage the economy in an appropriate way, and that independence is key to doing that. And that's why it seems like we, through these boom or bust cycles, we always seem to come out okay, and no matter what. There's never been a time. I mean, how many times has it been said that the United States economy is going down and we're not going to be the leader, and it always turns out, no matter what, that we still emerge that we are. It seems to me, I mean, I don't know if I'm overstating that, but I don't know if you can comment on that at all.
No, I don't think so. I mean, I think we largely agree on that. There's going back to the economic side of things, the power of strong institutions is an important part of economic growth and market efficiency, and so we have those. Those are real advantages for us. And in situations where people are critical of, particularly the Federal Reserve, it tends to be things like stepping in during the financial crisis and bailing out some of the banks and the auto manufacturers. Those were decisions that I think people can have debates about, but ultimately saving those organizations was for the betterment of financial markets. And if they were to collapse, we could have been in a much deeper hole than what we found ourselves in. So I think there are important discussions to have about the extent of those powers and how far they should go. But in general, I think the Fed has done.
It's an understandable view, perhaps, to say that the government bailing out some big business seems unfair, maybe to some people. But if a business truly is too big to fail, whether it's a financial business, a bank, or the auto industry, I mean, it would seem to me, it would seem, where would you be if in a modern economy if you don't have a developing and thriving auto industry that is healthy, provides jobs to a lot of people, has a lot of industries that are related to it that just filter out into the economy in all different ways, and is trending forward, to me, in a positive way with the products that they're bringing online, electric cars and all these kinds of things. So you don't want to not have that, and you don't want it to not be healthy. And if at some point something has to be done to help it, well, why not? Not all the time. It's not like it's a state-owned business, but it's like, it's prudent to understand how important those industries are to the health and well-being of the country. It seems to me. So I think you're agreeing with that, and a balanced approach to these things that's not too jingoistic in one way or another is the right way to approach things.
Absolutely.
Looking at things currently, and getting back to the market, how do you feel the markets will respond to the policies that are currently, or is it responding to control inflation?
Yeah, so I mean what's happening, what has happened over the last several months is a dramatic increase in interest rates from the Federal Reserve. And so, we saw 425 basis points of interest rate increases in 2022. That's the most that we've seen since 1980. And then we had another 25 basis point increase this year. So over the last 12 months, 450 basis points, that's a lot of tightening of the economy. All of that, again, is devoted towards trying to bring inflation back down to the 2% target that the Federal Reserve has. And so markets are digesting those changes. It's been a pretty significant change for them to work through. But one of the things where it's left us is with much higher interest rates across the yield term, the Treasury yield curve. than what we saw before those increases went into effect. We're coming out of a long period where interest rates were ultra low, and that really made equity markets. There's this acronym TINA. There is no alternative, and it's because there was no yield really in fixed income markets, and that really made equity markets the only game in town in some people's from some people's point of view. That's really no longer the case. I mean, fixed income those asset classes are now very much attractive in terms of the yield they can offer an income investor, as well as the potential for risk-adjusted total returns for somebody who's interested there. So I think that the changes we've seen in markets are pretty significant and are really interesting. From where we were just pre-pandemic to where we are now, there's quite a bit more for investors to consider.
Strife in the world, political conflict, natural disasters, wars. We've got a war in Ukraine. We've got the prospect of conflict that always seems to exist. How do the markets react to those circumstances, and can they adjust for it? Can they withstand it? What is your view on that?
Well, I mean, financial markets do adjust to those things as those risks change. Unfortunately, those risks are still with us as we head into 2023, particularly the war in Ukraine. A lot of the inflationary forces that we saw building in early 2021 had to do with an increase in energy costs coming from concerns there. Luckily, it seems like the European economy, which is going to be more exposed to issues with the supply of oil and natural gas coming from Russia, it seems like they made it through the winter with relatively was able to maintain their stockpiles. We didn't have any shutdowns of manufacturing facilities to conserve energy. Those sorts of things were certainly on the table. So heading into as we exit the winter, heading into the warmer months, it seems like they have avoided the worst case scenario there. It's nothing to say that when the next winter comes around that they will have the same luck in terms of weather that didn't require the same energy demand that we might have expected. So those risks are still there. Markets are always interpreting those risks as they arise and reflecting them in prices. As I mentioned before, I mean, markets are forward-looking, and so they're judging not just the war in Ukraine, but perhaps greater tensions with China. They are incorporating that all the time.
With all of these factors, the Fed's attempts to contain inflation and all the factors we've spoken about today, in your view, have investment priorities shifted from equities to bonds and things of that nature? And what is the effect of all these factors, that might, for people that might be living on a fixed income? I would imagine the bond market is it would be better right now. I mean, the returns, so that might be good for folks on fixed income if they're in bonds. How do you see that, and how do you see that playing out in 2023 and beyond?
Yeah, well, looking forward from today, we do think that fixed income markets are offering attractive opportunities, again, for people who are looking for total return, interested there, as well as pure income investors who are just looking to generate some income from their portfolios. I mentioned that interest rates are significantly higher after the Federal Reserve's actions last year. I mean, the 1-year Treasury yield is at 4.7%, the 10-year Treasury yield at 3.5%. I mean, those are real yields for investors to capture. And the other thing to keep in mind, from the total return perspective, is that now that interest rates are higher, there is some room to cut. So, should we see an economic contraction, perhaps traditional monetary policy comes into effect, we see some interest rate cuts. As interest rates come down, those Treasury yields are going to prove nice total return generators also. So we do think that though 2022 was a difficult year for fixed income, one of the worst on record. In fact, we think looking forward, fixed income offers a lot of attractive opportunities, more than we've seen for several years.
Well, that's been very informative. You are obviously a wealth of data and information, very conversational, very illuminating. I very much appreciate your time, and I hope to have you back again, and look forward to that. But that is our podcast for today, and we will see you next time on Your Inheritance.
You've been tuning in to Your Inheritance, your rights, your obligations, your responsibilities, with your host, Peter Bochnewich. If you're being sued over an estate, or if you feel you're not getting your share, Peter's firm can help you. You can find this show at www.betrustlaw.com and on YouTube, Facebook, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive feedback, comments, questions, and for sharing the show with others.